Nigeria's markets are navigating a complex macro and global backdrop. The Central Bank of Nigeria recently cut its benchmark policy rate to 26.5%, a notable shift after months of tightening. While the economy just also recorded a solid 4.07 real GDP growth in Q4 of 2025, driven by broad-based activity across oil and non-oil sectors. But it is not just the local headlines that matter. Global debt rose by $29 trillion to $348 trillion as of the first 2 months of 2026. Now, the US financial markets have seen major bank stocks slide sharply this week, with big names like Goldman Sachs, Morgan Stanley down significantly amid credit and AI related stress, pulling the general indexes lower. So, in this episode, we unpack the macro and global dynamics that investors are facing now. We'll unpack CBN's recent policy move, what that means for the Nigerian capital markets, the Naira, the market liquidity. We'll also touch on corporate headlines like Dangote's listing plans and MTN's return to dividend payment. So you really want to stay with us to the end, because together we'll be providing tactical insights that investors need to know now, given the complexity around the current investing environment. So welcome everyone, and you are right here on the edge. And joining me today to really unpack all of this is Andrew Esene. Andrew is head investment at FCA Asset Management. Andrew, welcome to the edge.
Thank you, Dr. Tony. Great to be here again.
All right, it's always my pleasure having you, to provide your insights into current happenings in the financial market. So let's start from the recent MPC decision. So CBN delivered its first policy rate cut of 2026, lowering the monetary policy rate from 27% to 26.5%. So I think this signals some cautious easing cycle amid the sustained disinflation and FX stability. Now, Nigerian inflation has slowed for months now. I think it's currently at about 15.1, yet the MPC made only a modest 50 basis point cut. From your perspective, does this kind of signal confidence in the disinflation trajectory, or caution that the monetary transmission mechanism is still fragile?
Okay, thanks, Doc. I think it's more a cautious move than an expression of, robust confidence in the disinflationary pressures that we've seen. Yes, we have seen the inflation rate drop on a month-on-month basis, and so that disinflation is clearly there. But food supply shocks still remain in the system, and because the CBN is also have a wider view to inflation in the medium to long term. So the 50 basis point cut signals that cautious position. The election, we're expecting the election cycle for the next presidential and federal elections. And even at that, the date has been moved back by 1 month.
Yeah, I was going to say that. So that means we're going to start seeing that pressure come through really soon.
Exactly. The excess liquidity in the system as a result of electioneering is expected to filter into the system, sooner than what would have been expected. So I think that was a real key factor that the Monetary Policy Committee, the MPC, considered in this moderate cut to the policy rate.
Okay, and you're aware as well, obviously, that they maintained the cash reserve ratio because, as you mentioned, inflation is still sky high. But critics have, called the MPC's move necessary but insufficient. What's your take on that?
The criticism is fair.
Okay.
Though, again, from what I've said, the global outlook or the national outlook, you will understand why the CBN did what they did. But in terms of supporting growth,
Yeah.
the moderate cut of 50 basis point does not really, you know, it doesn't really affect lending rates, especially for SMEs and in terms of supporting growth. So it was necessary but insufficient, like they have said. It's insufficient. We don't expect to see rates moderate downwards. Even the equities market that will naturally benefit from a rate cut, we did not see that happen. So it was insufficient to move. But I think the major message there is the signaling that yes, since the CBN has adopted an orthodox inflation targeting what would I call it now?
You-
Post, so that is what they are following. But it's just a signal that yes, there is this inflation, but pressures still remain, and we're keeping our eyes on those pressures.
I mean, I think it's an interesting topic, really, because the GDP came strong at 4.07. So, should the CBN or the MPC really be bothered about growth?
Yeah.
Because it kind of looks like the economy is moving in the right direction. So, the lending rate obviously would mirror
Mm.
the monetary policy rate, which is currently at 26.5. So, is this a game changer for struggling businesses? Would they be able to access funds, or banks will just still maintain that premium due to the risk and liquidity conditions?
The risk premium remain high for bank lending, especially with the infrastructural defects that we have. The risks to businesses and SMEs in terms of um, making the investments and then getting an adequate return to service the loans that they take from the banks is still high. And so the banks, I believe, will maintain that premium. The rate cut was just a signal. It will not necessarily dovetail into lower lending rates for SMEs. So it's not a game changer for lending in the corporate space for SMEs.
And not a good news as well for businesses.
Yeah, it's supposed to be, but it's not going to.
Yeah, that's why it's insufficient, even though it's a necessary move. But I think a lot of analysts were optimistic that it was going to be somewhere between 100 and 200 basis point. But obviously, taking in totality the current environment, we have the election spendings coming up, which could alter the direction of inflation. So I think they took all that into consideration before arriving at that 50 basis point, which is, just say, okay, hey, guys, take this and we'll come back later. All right. So the central bank governor did mention that the foreign reserves hit about $50.45 billion, which is the highest in 13 years. Naira has shown relative calm and stability, I think about 1,350 Naira to a dollar. So, how important was the FX stability in giving the CBN room to cut, and what are the risks if the election year fiscal spending injects liquidity back into the system? What are the possible risks that we might see?
Okay, the FX stability is critical, and like you said, that was a good position for the C that informed the CBN's action with FX levels above 50 billion the FX reserve levels above $50 billion. So the CBN had the cushion, the confidence to actually um, effect the rate cut, though modest. The risk would be there could be a reverse in capital flows if that cut was much more than what would have what it was. There could be a reverse in capital flows, reignite FX pressures, so increased liquidity will force for greater demand for FX even as we go into the election season, and then it will force the CBN back into tightening mode. So um, the balance between FX stability and the election risk, it's the election year risk is something that is a delicate balance that the CBN is playing. So on one hand, the improved position gives the CBN the confidence, to cut rates. But on the other hand, is also watching to ensure that we are not, it's not forced back into tightening again because of the coming elections.
So it sounds like the CBN focused or prioritized FX stability more than every other metrics. They were watching that keenly, and you just touched on it there that they were cautious or scared that there could be fund reversal, which would then put the naira into some
Yeah,
troubled waters,
yeah,
as you said.
yeah.
Okay. I think away from the central bank's the MPC decision, let's talk about the general market now. Let me have your take about what happened last week. But before I do that, just again, if you are joining us for the first time, if you're watching this channel for the first time, we're here every weekend dissecting the financial markets and providing investors context and actionable insight on how to navigate the investing environment. So please give this video a like, subscribe to this channel, and share the link with your communities. So Andrew, the markets are digesting both the policy shifts and the corporate signals that we've seen, with sectors reacting differently on equities, on the fixed income side, given the markets or given what the market deemed as necessary but insufficient rate cuts by the MPC. So, how did the equities market react to the MPC rates decision?
Okay, so typically the market will react positively because it would mean a drop in secondary market yields for fixed income products, and then it will improve the attractiveness of the equities market. But what we saw, again, taking from the fact that this was insufficient, was that the market lost 1.1% last week.
Okay.
On Friday, it dropped 38 basis points as well to accumulating to the 1.1% loss. So the market still did drop despite the rate cut. But the market is actually trading in an overbought position, so to say. We've seen um, prices trading at historical highs. The market has done about 25% year to date.
Mm-hmm.
Almost half of what it did for the whole of 2025
2020.
already in just 2 months. So prices were trading at historical levels. The likes of Dangote Cement, Seplat, MTN, the key names, the top tier names were trading at new highs, historical highs. And so the drop in prices was expected. The short-term profit taking was expected, and that is what really played out in the market. So even if the market was going to react positively to the rate cut, the overweight of um, mild profit taking that we saw naturally, reduce the effect of the NPR rate cut. But as you mentioned, the rate cut was insufficient. So it's not something that the market would really, investors would really jump into the equities market just because of that moderate rate cut. So the market did react. Um, well, we didn't see the market react to that rate cut as well. at all
Yeah,
because we
that,
have
that
system.
that's I mean that was my observation as well. I think on the fixed income side, we saw yields rise. I think maybe about 20 or 30 basis point from where it closed prior to the MPC's rate decision. Obviously, the market was expecting something more, but as we said, the MPC has an umbrella view or helicopter view, rather, of the economy, and they can really dissect or know where the economy might be headed if they had given that hefty cut that market was expecting. But you talked on Seplat, you also talked about MTN. So let's talk about Seplat for. So Seplat announced a dividend payout, I think about 5 cents, plus I think another $3 3 cents special, which kind of signals booming confidence in the energy market. I mean, we're still going to talk about the whole crisis, that has just started in the Middle East. But is this dividend payout by Seplat, is it sufficient to attract investors, and how should investors position themselves to capitalize on this without the getting into the oil price swings?
Okay, well, Seplat has been known to pay quarterly dividends to its shareholders, and so for income investors, it's it's a good it's a good play for them. It's a
Mhm.
good stock to consider for income investors. I think they are the only, apart from the Nigerian Infrastructure Debt Fund, that makes quarterly payments to investors.
Yeah.
Seplat is the only equity stock that pays quarterly dividends to investors that I can remember. So for income investors, it's good, but at the same time, it's also trading at about 9,000 naira per share, coming from its previous level about around 6,900. So it's also trading at a pretty high price. So we would not advise investors to be chasing um, the particular stock at this time. It would be better to accumulate on a pullback, and then position for future dividend payments. And since it's quarterly, they won't have to wait for too long. And also for a an energy stock like Seplat, watching the global space as it relates to regional conflicts and the impact on oil prices is also key.
Okay.
Although in the medium term, in the short term, it's positive for them because they have increased global oil prices to supply to. But we also there is also the concern of this global conflicts feeding into inflationary pressures in the economy as well because of international oil prices. So, on one hand, for income investors, it's a good play, but you don't want to start chasing um, particular stocks at the prices that they are now. There would naturally be a pullback, and to be better to position at that pullback period.
Okay, so you don't expect it to continue to on this upward trajectory, because it's trading at more, it's kind of pricey. Is that what you're saying?
For the medium to long term, yes, it will continue to reflects its earnings, and higher earnings from higher oil prices
Okay.
for the medium to long term, it will still do well, just as it grew from 6,900 to about 9,000. But for investors that want to position, it will be best for them to wait for a pullback, even upon the markdown of the dividends. That would also drive the price. It will also drag the price lower a bit. It
Lower
will
a
be
bit.
best to
Okay.
position at that period and then
So that would be
wait.
the advised entry time that investors
Yes.
should watch out for.
Yeah.
Okay, so let's talk about MTN as well. So MTN resumed payment of dividends. I think they are proposing a 20 naira per share after skipping dividend payouts through those tough years. So, and the stock obviously has been riding on a high in the bullish market, as you have pointed earlier. Should retail investors be rushing to load up on MTN right now for those juicy cash returns? And the potential upside that might come, or is the risk still locking? From foreign exchange volatility, are there regulatory pressures that that we might be that investors should be watching out, or competition that could hit the dividend payment that MTN just made for 2025?
Yeah, all the factors you mentioned are still potential risks that could affect the company, although at varying levels. The last issue the company had with regulation as related to tax payments that was really almost blown out of proportion. We did see changes to their board, and technocrats and industry experts were brought in both on the regulator side. The former chairman of the NCC is on the board, the former chairman of the FIRS is also on the board. So they have how do you call it? They have there are a lot of people on the board that can provide the guidance that they need to be
Okay,
able
it's more
to
like improving
navigate.
on corporate governance, the technical
Yes,
know-how,
yes,
and all that for the
yeah,
company. Okay.
yeah, and navigate those regulatory landmines that may be there. But in terms of positioning in the stock, again, it is not advisable for investors to chase a rising stock, because at the end of the day, you may just have institutional and short-term traders just um, sell off,
Okay.
dump on them, and then they'll be holding the bag at the end of the day. It is always best to position in a stock when it is, on its way down or there's a slight pullback than chasing it at a high. Chase at a high and you get at that level, then the pullback occurs, you already be negative, you already be holding a loss in your hands. So, and then you're not waiting for the price to recover, to even um, um, get back to your cost level before you now start looking at making profit. So it's not advisable to chase stocks. The 15 naira final dividend, making
Yeah.
a total of 20 naira, it's quite attractive, and it was largely unexpected. Even when they paid the interim dividend of 5 naira, that was not expected really. So it's a good one, and it shows the strength, of the company. I think they reported revenue of around 5 trillion thereabouts. Much I'm quite sure now. So that's the growth in the company, being a market leader, and then in a space that continues to grow, not even to talk about their other value added services apart from just voice. We're also seeing accretion in those particular services in terms of revenue. So for the medium to long term, it's still a good play, and we expect that those dividend payments will still continue to come.
Okay. I mean, the price has gone up, so it means that the dividend yield, even though it's $20, is not, that juicy as it
Attractive,
were.
yeah,
But overall,
yeah,
if you look at the capital gain yield and the dividend yield, then you should think that the
yeah. The
total
total
return,
return,
the total
yeah,
return will be attractive. But Andrew, some people will say, with the fact that we've had these tariffs for telcos that have just been revised upward, that telcos and especially companies like MTN will continue to see that growth in revenue, which will
yeah.
mean that we might see the price remain at this level or even continue to go up. What do you think about that?
Okay, yeah, you're right. Recently, the tariff prices for calls were increased, so
Mhm.
the growth in revenue was expected. So
Yeah,
for such a given that scenario, for investors not to totally lose out, you just you're holding your money and the stock keeps climbing. Maybe what you want to do is to take a position.
yeah,
Say you have 100% of your funds to invest. You can't choose to go in with about 25, 30%, just so
stagger.
that you're already in, stagger your entry, given that a particular scenario that subsequent quarterly results will show that improvement since the increase in revenue is expected. So given that position, it will be wise to manage your entry into this stock.
Okay, sounds good. Let's switch gears a bit and talk about the Dangote Refinery listing. I know you had mentioned that previously on the edge, where you said that this was going to be like the listing of a lifetime. So probably Dangote listened to you and then it said, okay, we're going to be doing this sometimes in the year. So Dangote has indicated ambition to list the shares of its refinery. One for, I mean, the refinery, I think, is the one of the largest single train, right? Refineries in the world. And
Mm.
that's, some have said, if Dangote should list on the NGS, that could totally reshape the NGX in terms of liquidity and index composition. So, if Dangote Refinery lists on both the, I think, the London Stock Exchange and the NGS, how could that affect the market cap concentration in the Nigerian stock market and the broader narrative, okay, about deepening Nigerian capital market?
Yeah, the death of Nigerian capital market, especially the stock market, is one that has been a concern for many investors, over
Yep.
time, because for foreign portfolio investors, when they do come into the market, there is just a handful of stocks that they can participate in,
Okay.
that have liquidity, high market cap, liquidity to come in and go out as they would prefer. So the listing of Dangote Refinery really widens the scope for them. At the last estimate, the expectation is that we're going to see the listing of Dangote Refinery and also the NNPC as well on the NGX, and that could take market capitalization from its current 140 trillion to about 260 trillion. So that was, almost going to double market
Wow.
capitalization. Yeah, but that of the NNPC is still not much public information concerning
Yeah, but
that
Andrew,
list.
why is that taking time? Because I think when they, they transitioned to, a public
Mm.
limited company, I thought that was one of the reasons why they did that. So why is it taking that long for them to come to the market?
Yeah, well, being a state corporation, I imagine that there's a lot of bureaucracy, and a lot of decisions that have to be made. The MD has come out to talk about a necessary cleanup, that is going on in the organization. So it's just, the bride getting ready for the D-Day, the wedding, so to say. So I think that whole getting the company ready for public scrutiny is what is taking that time. Yeah.
Wow. I mean, so let's see if both of those both companies could be listed on the index, that would be really significant for the Nigerian capital market. But
Yeah,
let's talk a bit about um, probably maybe valuations now. But so given the margins for maybe a refinery will be tied to global oil prices, FX dynamics, local regulatory policy. So, what are the key factors that anyone watching, maybe an institutional investor or retail investor, what are those key factors that you think they should consider when you're beginning to conceive the idea of valuing such a company?
okay. Well, traditionally you would value using the projected cash flows,
Okay.
of the company, but um, the hype, that has greeted the listing of the NGX and the listing of the refinery on the NGX, and then the positive sentiment surrounding it, there is already a demand, a waiting um, investing public that is just waiting for the listing. And for those retail investors, local retail investors, the idea is just to get it, at
Mm-hmm.
the price it is listed. But for institutional investors that will look more to the valuation and compare it to global peers, you have the projected cash flows, you have, like you've mentioned, the margins that we'll be looking at. We have the FX exposure on their debt side, if
Yeah.
how significant that is, and then if the funds that will be raised from this listing will be used to refinance those positions. Also, concerns around their feedstock is also one concern that institutional investors will have. So there's a list of factors institutional investors will look to, but the company is just looking to list 10% of its
Yeah,
shares
I
on
was
the
going to ask you as well to talk about that. So they're just going to
yeah.
be listing 10%.
Yeah, because the depth of the market would not um, take significant share of the company, to list that on the exchange. A few investment banks have been, financial advisors have been appointed to help to uh,
The
midwife
issuing
the
process.
process, the issuing process. So those are the factors that really institutional investors will look to.
So
The projected.
do we have like a definite time when this will come to the market or when the issuing process will be concluded?
Well, the president of Dangote Group did mention that the listing will be done in the month of July. So we're
July.
just about
So
5 months away.
everyone go get your cash ready.
Mm, yeah. So the impact it will have, the hope is that it will attract fresh funds into the market, but I think there's also the expectation that we might see some sell down in some particular sectors positioning that.
Yes, I was going to ask you about that as well. So would the timing of this, everyone had been waiting, this mega listing, would it crowd out liquidity from existing heavyweights or could it deepen market participation longer term? And
Mm.
how might this mega listing, how might it transform the energy sector, especially helping Nigeria to lure foreign exchange into the country?
Yeah, I think you're right on both counts. In the short term, we would see some movement of funds,
Hmm.
some sector rotation out of where sectors that traditionally attract funding, like the tier one banks, and other energy players into the public offer of the Dangote Refinery.
Yeah.
So in the short term, we will see that crowd out effect. But in the medium to long term, we expect that fresh funds will be attracted. Foreign portfolio investors, institutional investors, will bring in fresh funds to invest in that in the particular offer. So the immediate effect might be negative for other sectors as people sell down to position. But in the medium to long term, we expect that it will also attract other emerging market players into the market as well.
And I mean, I can only imagine what would happen to the FX, Naira if this comes true, because obviously, I think whether last week or thereabout, you had Dangote saying the Naira might exchange for somewhere around 1,000 Naira to a dollar.
Um,
So that's really something that we should keep an eye on. So
yeah,
as the
given that
refinery, yes.
they're looking to increase their production volumes to 1.4
Mm-hmm.
million barrels per day, and the FX inflows that would come in as a result of that. So the expectation is that the increased FX inflows will even further improve our foreign reserve levels and then give greater confidence, help to stabilize the naira to the level Mr. Alhaji Dangote has predicted. So,
So what I'm hearing from you clearly is this is a must buy.
well, we would um, unfortunately, the numbers are not public. They are not numbers
Okay.
that we can get our hands on. But the it has been touted as the offer of the it's more than the offer of the year. So the positive sentiment surrounding it will push a lot of um, people into it. Typically, what we've seen in the market is upon listing, there is a rally,
Yeah.
in the share price. It's just depending on the volume of the stocks that will be made available to the market. It may not be available for the demand, and then the price will just trend us. But over time, we see that prices tend to, stabilize. So some experienced investors would want to position when the prices stabilize, than joining the head to rush at the initial time. When that price will stabilize and the price it will stabilize at,
Mm.
is something that we will see in the future. But typically, what I would do personally is get in with part of the funds again, a managed, staggered entry.
Yeah, kind of
Get in
stagger
and then
your entry.
watch how it goes. Yes, that's really the safe way to play the market. Stagger your entry, and when it stabilizes and more information about the company is known and released on the NGX, then we now know the appropriate valuations to apply, and
Right.
the
Thank you.
pricing to
Yeah, thank
that will
you
be that will be okay.
for providing that advice, Andrew. Again, everyone, if you just joining us for the first time, you are right here on the edge. And like this video, subscribe, share with your community. We are here every weekend providing technical insight into the financial markets and helping investors deepen their knowledge about the market and how and what they should be acting on. All right, Andrew, let's move now into, let's talk more about the global market now. So early this morning, we all, read or watched that video um, about the US president announcing actions in Iran. So, with the tensions now escalating in the Middle East, crude oil prices have become more volatile. I think Brent crude immediately went to, I think, about $73 to a barrel. So, for an oil exporting country or for oil exporting countries like Nigeria, higher prices could boost fiscal revenue. But globally, it could also reignite inflation pressure. So the Middle East tensions keep oil prices. So if the Middle East tension keeps oil prices at elevated level. Does that create a short-term fiscal boost for oil exporting countries like Nigeria, or does that even provide a more bigger or exposes the country to more bigger risk like inflation coming back that could further delay rate cuts across maybe major economies, and we might be back to tightening monetary policy conditions?
Yeah. Unfortunately, though the regional conflicts, the renewed
Yes,
conflicts between the um, US and Israel on one hand, and then Iran on
yes,
the other hand, is leading to lots of lives and destruction.
yeah.
Oil exporters like Nigeria stand to benefit from the increased oil prices because we are exporters. But that will only be if we're able to maintain our production levels, or even grow our production levels, to tap into
Beyond the
that
current level.
beyond the current levels and even hit the 2 million barrel per day production that the current administration has as a target. But historically, we've not been able to do that. You know, we've always been producing below even the OPEC target, that we had. So unless we are able to increase our production volumes, we'll not be able to benefit from the higher oil prices, and then the accretion to our foreign reserves will not really be there. But as you said, on the other counts, so if we are not able to do that and we're not able to get higher revenues from the higher oil prices, we will
They might be
suffer
exposed to
the
inflation.
second leg. Exactly. And we know that, again, the Dangote Refinery, although we've seen that stability in pricing and in production, but
Yeah.
the price levels are always adjusted to reflect, international realities. And so, if international crude oil prices continue to rise, as you've mentioned, then we will see the adjustment in local prices as well, and that will be an upward review of the pricing, especially given that the refinery also has to export, has to import crude oil
Yeah,
to
they still do some imports
feedstock.
from foreign
Yeah,
countries. Okay.
yeah, to get feedstock for the refinery itself. So, um, like you said, inflationary pressures, it will lead to inflationary pressures. If that continue. So it's either we benefit from one hand or we suffer on the other hand. The level to which we benefit depends on our production levels, and then as long as the conflict continues and international crude oil prices are volatile, we will see higher oil prices from the pumps in Nigeria.
Okay. So in periods like this, so in periods of geopolitical escalation, we typically see a flight to safety, especially into maybe U.S. Treasuries and U.S. dollars. So how vulnerable are emerging and frontier markets to capital outflows if risk aversion deepens as a result of the escalation of this violence, these attacks currently happening in the Middle East? And what indicators should investors monitor, maybe to be able to gauge whether this becomes a temporary shock or a sustained repricing of risk?
Okay, so historically, emerging and frontier economies like ours uh, are largely vulnerable to capital flights. When
Mm-hmm.
this happens, we see a flight to safety to U.S. Treasuries, the U.S. dollar, and then to gold. And so, even some analysts have projected that the price of gold is expected to hit about $7,000 an ounce on
Wow.
the back of the regional conflicts. And so, that flight to safety means capital flight away from frontier market assets, Naira assets in the case of Nigeria. However, we have had in recent times where we see local investors dominate our market, especially the equities market. The current ratio stands at about 87 to 13 percent. It's
The
7%
proportion
individual
of
investors.
local versus
Yeah,
foreign
local
investors.
versus foreign portfolio investors. It's 7 to 13%. And so a capital flight to safety from foreign portfolio investors would not significantly impact the equities market, because of that weighting that they currently have. For indicators to watch for institutional investors, whether this flight would be temporary or sustained. We watch U.S. Treasuries to see if there is a sustained interest, in
In
that
U.S.
the
Treasury.
strengthening
Okay.
of the U.S. dollar, U.S. Treasury, first name U.S. dollar, again gold. If that price will be sustained. If it is sustained, then we know that that's the sell pressure, the sell down on frontier market assets, will be significant. But if we see those indicators just plateau in a season after some time, then we know that maybe the global investors have, even the regional conflicts was anticipated.
Yeah.
There's been talks around it for a while, and given the build up of the U.S. military around the
Military
target.
assets in the Middle East.
Exactly. So
Yeah.
that has been they may have factored in this attacks have been issued, and so if we see these particular indicators um, moderate in the short term, then we know that it will not be a sustained it will not be a sustained pullout from frontier market assets.
Okay. Thank you for providing that insight, Andrew. Now let's talk now about tactical positioning and outlook. And where I want to start from first is during periods of war, okay, especially one that it's where it's happening now in the Middle East, are there specific sectors that investors should be interested in? Are there, because I know that typically um, defense companies, oil and gas companies, as you mentioned, aviation are usually the sectors that benefit during this period. Are there sectors, are there sectors you think that investors that are watching us locally or globally should be paying attention to?
And so, as you mentioned, normally the defense sectors they get increased contracts, for production,
Hmm.
so that is um, given. For aviation, I'm not really sure. It depends on the particular routes that we are looking at, particular companies and the routes that they cover,
Yeah, because the
to
companies that
see.
provide that produce, the likes of
Yeah, this
the likes of
the
Lockheed
aircraft.
Martins, Norton Groups, and all that. These are U.S. companies that historically, during
Mm,
period of war, have been the major beneficiaries. They've seen increased patronage, increased stock
yeah,
prices, and all that. I think
yeah,
investors might want to look out for major when periods like this happen, because when
yeah,
there is this type of escalation, there are people who pull back and there are people who take this as an opportunity to invest. And that's one of the reasons why this platform is there, so that we can always surface those opportunities and
yeah,
concentrate investors' mind on what you really should be looking at, not necessarily following the noise. Okay.
yeah,
So, Andrew, let's also look at so MPC cut rates. We've all said it's necessary but insufficient. So, which asset class, as we speak now, offers better risk-adjusted returns from where we are now going forward? And which sectors would you be out to wait for in the coming weeks and going into the next quarter?
Okay. In terms of sectors or more like asset classes,
Mm-hmm.
the fixed income market, the short end of the fixed income market, the money market, I think we have high yield fixed income products,
Yeah,
that
there are
investors
still
can consider.
15, 16,
Yeah,
sixteen
on the on the
percent on
on the
those
treasury
levels.
bill
Yeah.
side, or even on the commercial paper side, we have um, analyzed yields of up to 23, 24%, for
Okay.
commercial papers that were issued in the market last week, and even some of them are still live in the market. So the high yield fixed income space is one that would look to after this pullback in the equities market, we could look at tier one banks. So typically they will do well, and they're just coming from recapitalization. They have more funds to deploy. That would be one. Telecom services as well. Already mentioned the increased tariffs, and so
Mm-hmm.
they would also do well. Then the energy sector, the likes of Seplat, Ondo is in recovery mode. They are coming out for a rights issue. So I would typically pick tier one banking space, energy, and then the telecom space. Outside of that would be the short term money market space, especially high quality commercial papers.
You didn't talk about Aradel. What do you make of
Okay, yeah, yeah,
the
yeah,
movements
yeah.
they've had so
So
far?
so the energy space, so that would include the likes of
Ara,
Seplat, Aradel, yeah.
but I mean, you already talked. You already gave your position on Seplat. You think it's currently pricey, and an investor
Mm.
should maybe take a staggered approach into investing in
Even
Seplat.
even even for ARA, they're traded as high as 1,094 naira per
Yeah.
share, but it's currently around 1,070. So we are seeing that
Kind of
the
pull
price
back
getting soft
slightly.
at those levels, and so investors should watch the position when it does pull back. It's currently
Okay.
weak.
Yeah. Sorry. Land on your thoughts.
Yeah, it's currently weak it's weak at its current price. So investors can get it lower.
Okay. So in closing, Andrew, what is the single most underestimated risk in the market right now? Would it be the sticky inflation, fiscal spending, FX volatility, or the global tension that we are beginning to, see unfold, or global capital asset reallocation, if there is a need to fly to safety?
I think the single risk um, that I see for inflation, inflation is known.
Okay.
We're currently experiencing this inflation here, though it remains sticky. But
Mm-hmm.
I think the MPC has a handle on that. And then with food inflation is also on a month-on-month basis still also trending downward. So I would say the single largest risk that we'll have will be on the FX, will be
The
on the
FX
FX side,
factor.
and that will be as a result of the um, regional conflicts that we have, the um, FX equilibrium, the delicate balance of FX equilibrium. When um, we see volatility in the exchange rate, it immediately feeds into inflationary pressures for us, and it
Yeah,
immediately, the MPC has to come in to stabilize that. So I think the FX risk is one that we still have to, though we've seen accretion in our levels, in reserve levels,
the
where prices
reserves
are going higher. If there is a displacement in the current arrangement that we have, it could quickly turn gory. And then also in the short term is the election cycle that we are facing. That also puts pressure on
on
the
inflation.
FX stability for us. So I would say
Oh,
FX
okay.
and
Yeah,
then the
on
coming
FX.
election
Okay.
cycle.
Yeah, that's true. I mean, given the fact that the spending, the election spending, most of the time is dollarized. So I agree with you. That could pose pressure on
Significant for us.
the current stability in the naira that we've
Yeah,
witnessed.
yeah.
All right. Thank you so
That's
much, Andrew, for your brilliant and insightful analysis. As always, it's always a delight listening to you take on these topics.
Thank you, Dr. Kafon. Pleasure being here again.
All right. And everyone, thank you so much for joining us today. If you like this episode, as I mentioned earlier, we're here every weekend. Like this video, hit the notification bell, subscribe to this channel, and share the links with your community. We're here every weekend providing insight into the financial markets. Andrew, any final thoughts from you? Any final words? Or
For investors, so like we said, the Naira assets are quite attractive, even though we have some we are currently trading some overbought positions, but just there are good offers in the market that can help one, invest wisely. The assets are there. It's just um, get the professional guidance that one needs, and then understand that it's the capital market. It's for long term investing, and not try to, as they say, time in the market is better than timing the market. So
time
that's my
in
last
the
one.
market is better than time in the market.
Yeah.
Wow, I think it's a good place to end it there. And they say a word is enough for the wise. All right, Andrew, thank you so much.
Thanks.
Everyone, thanks. It's been a wonderful time with you. All right, take care, and we are out.
All right. Thank you.
Bye.